because we're just getting to know each other. Nobody wants to sort of, upset the apple cart, and sort of like going on some early first dates. Storming, as you get further in, is when really the sort of moment of truth sort of starts to sort of unfold. And storming is when, you know what, I actually don't really like your idea. And I'm going to say it in a way that is uncomfortable, and you haven't heard me say that before. It's like, wait a minute, that's not the nicey nice that I remember. So, and that sort of unfolds a set of, basically the team starts to recalibrate its relations. And how it basically is a process by which the team is learning how to fight. If you have a bad apple, bad apples don't fight fair. Good teams know how to fight fair. So you go through this storming phase, and basically it's a reset. And that's when you get into norming. Things sort of level out. We now sort of understand, and you start to understand that when I critique your idea, I'm not really critiquing you, it's just like the way I am. And so you normalize out. Performing is the final stage and only happens about a quarter of the time. 35 years, I've seen it happen once in a prior team, and it's happening in my current team at levels I've never seen it happen at this level, which is a variety of reasons.
Don't talk too much about success,
But performing is when the team really knows how to give constructive feedback and challenge the problems, because failure is about problems, and whether you fail well is whether you overcome those. And teams that perform put the fish on the table, reality is your friend, and they fight fair to solve it.
That's some great insight. And I'm sure you can add to that in terms of helping teams early on when they're forming deal with some of these problems, but also as they have their first challenge as a team or there is a conflict within the team. How do you advise, and what are some of the situations you've dealt with in the past related to that?
Yeah, I would definitely like to piggyback on what John just said, because I think those phases are very important, but they're not done once you potentially hit the performing phase. Because as a startup continues to grow and adds new talent, hires new people, you're starting to form again. And then you're starting to norm again, and you're storming again. And hopefully you're ending up performing in some shape or form. But we've definitely seen teams that miss out on some of those opportunities to actually step back and acknowledge what competencies got us here won't necessarily get us there. And who do we need on the team? What kind of talent do we need to not continue to exercise the founder's arrogance of saying, I can do it all. We launched it, we know what we're doing, and we don't need to get outside help. And I think that is really important, that you realize what competencies you need at every stage of the startup, and really be very deliberate and diligent about getting that talent on the team. And so you're actually never going to be done on those 4 phases. It's like an iterative process that's like a spiral, continuing to move on as your startup grows.
Let me just give a very real example. So we are in the process, we're in the final phase of a 4-month search for a vice president of operations. And this is a senior person. It's looking like the candidate's going to have had 30 years of experience. So understand there's me, and there's 4 founders who are basically 22 years old. Actually, one's 28. So we're about to bring in a new sort of alien life form. And the way we're going to manage this is we have an organizational psychologist who's coming in Monday. He's going to spend 2 hours interviewing our final candidate. They've been given a battery of tests over the weekend, which I want to add, the first thing I did when I jumped into this company is I brought Michael in. All of us took the tests. We spent a morning with him talking through 4 stages of team development, what the tests said. As an example, we took Myers-Briggs. We're all thinkers. Sent a feeler in the group. So we had some like, well, okay, so you don't have a lot of feeling here. A lot of, kind of sort of touchy-feely kind of orientation. What are you going to do when somebody comes in who's got that? The person we're looking to hire, I think, has got that. And so we are definitely going to have to revisit. We will probably have a version of storming. I am anticipating 60 days from now, I'm going to get a founder coming to my office, closing the door. I just sort of went getting a little worried, and we're going to be having to do the reset. If we do our job well in the hiring and with the work we're doing over the weekend on a Monday, I think we're going to have managed the risks, and we're going to talk very openly about it before we give her the offer as to exactly what the storming risks are. We're going to go in with our eyes wide open.
And I think that's definitely something we are seeing when students or founders, come together. They are oftentimes friends. So you already have like a baseline of thinking alike, getting along, and you really want that diversity on the team. And it is something we are trying to teach the students, to say you have to value the diversity aspect to get the different backgrounds and get the different experiences in, but that's hard. And if you don't have the culture baseline right from the get-go to have open and honest conversations, you're actually missing out on an opportunity to harvest the fruits of some of those diversity discussions that could really bring. Like that person could end up being the one person, sidelined because he is a sensing person rather a thinking person. And that could be really, really tough. So having those open conversations early on and really being brutally honest, even if it's hard. And if it's your friends, that's making it even harder. What's more important, sustaining the startup or sustaining the friendship? And sometimes it's a close call.
I think one thing that was left unsaid in that anecdote you just gave about bringing in somebody from the outside, the psychological profiler, is that what his job was? Is that you have the experience of having already gone through that bad apple scenario where there was a team dynamics didn't work, to know that this is what you need to do. And I think that's very important. And I think those are the lessons that are key that we are, like that lesson is key that you're sharing, that from your prior experience, that this is something that needs to happen to make sure that team dynamics work. And as they, as you have that moment where somebody's walking in with a situation, already know how to handle it because you've done it before. And I think that's the wisdom that you can share with your co-founders and you can share with members of your team. Part of the other experiences are kind of deeper failures that you've had. You mentioned the company that didn't do well. And I will get into that, but I first want to ask you, and as part of this question of pivoting versus failing, right? How do you know when to guide a team that is going in the wrong direction and send them in a direction that will be better for them, and what are some of the challenges that are inherent in that? I'm sure you see that a bunch, and I'm sure you've dealt with that, pivoting versus failing. But I want to get your take, having dealt with a lot of different teams that are young that have to go through that for the first time.
So we really want to make sure that the students are sitting in the driver's seat, and they're actually the ones recognizing that they are capable of making that decision. So we wouldn't discourage a team from saying, you're going down a rabbit hole and that might not lead to something. We are trying to steer them in the right directions. So for example, we had a team that focused on concussion detection. And they've been spending like a year and a half, on the prototyping side. And concussion obviously is a very hot topic. And they got very good traction from the external world. But then coincidentally, they talked with construction managers. And the construction manager said, well, gee, if you can detect concussion on this side, could you do that for the construction side? And they're like, what are you talking about? That's not our thing. And they were very reluctant in that. They were all athletes. They figured, we know what athletes need. Like, we don't really need to circle the market extensively to figure out if there's really, our product really hits into a niche and we can really create some lever here. And they started to have more conversations in the construction space, and they realized that that is actually a much bigger market, much more opportunity, less competition, and they started to enter that market. And they've raised like a couple of millions now, and are very successful. And I think being able to actually trust some of that serendipity and being able to trust, that maybe another direction can lead you down a different path, that's a decision point that is up to them. Like, that's part of the learning experience that you go through as an entrepreneur, and also being able to listen to the mentors that you're interacting with and networking smartly, I think, is one of the biggest challenges that I see entrepreneurs have. Like, don't be in your own little bubble, but be able to go out and talk to disciplines that have nothing to do with your innate startup. You don't know who they know. You don't know, what other aspects they can bring to the table and how they can diversify your idea. And I think that's been very critical for student teams and for young alumni who go out and start their startup.
What about when they, probably the hardest part of your job is having the conversation with the company that is falling apart? How do you guide them to take the lessons that they should be learning from that opportunity and make sure that they're understanding that it is even though this idea that they may have been passionate about isn't going to work, there is a lot to be culled from the experience. How does that conversation go?
Yeah, and that's actually a really important point, because I do think students, we all are so indoctrinated by our educational experiences of failure is not necessarily a good thing, that once failure happens, there is oftentimes a lot of discouragement and them to be ready to give up. So we perceive us partly also as cheerleaders and as motivational speakers, to extract some of those lessons and help them see that that was part of the learning and they should just keep going on. It wasn't an indicator of them being not good enough or not having had a great idea or not being able to figure it out for something else. It's really more about, you learned a lot, and next time, regardless of what your idea is, you're going to perform and operationalize it so much faster. So it's a lot of developmental work that actually goes into that, and unlearning what they've been indoctrinated with in our educational system for the last 12 years.
Yeah, that is that perception of what you're supposed to do versus what actually could be more beneficial for you is tough to break that habit, especially from student entrepreneurs. You mentioned the company that sold for 25 cents on the dollar, but before that you had already had successes as well. What did you take from both the successes and that experience that didn't turn out so great that you're applying now, that you have a better sense, you've seen it happen, so you don't want to make it happen again? What are some of the things that I think are kind of driving the success that you're seeing now?
So I think that when you have an outcome like my last company, you will do some introspection. So as we were selling the company, the reality is in the final 4 weeks, the CEO becomes irrelevant because the CFO and the lawyers are doing all the work. So I started to go out to conferences and such. And I went to an economy conference out at Babson. It was really, it's a little bit of a segue, but it really sort of there was an aha moment and sort of led me where I am now. And so it was something like the future of cities and technology and innovation or whatever. I'm going through it, it's interesting. I'm sort of trying to get my brain sort of thinking about what's next and so on. And I go to this panel in the afternoon. I mean, I'm not getting that much out of it, but it's okay, but it's not great. And I go to this panel, and I don't even remember what the panel was about, but I do remember that the first guy up was the guy who runs the MIT Media Lab. And he gets up to the podium, and he puts his hand on the podium, and he goes, it's all about catching the wave, right? And I don't know what was going on in my brain, but all the tumblers clicked. I said, that is exactly what it is about. That is exactly the problem that I just came out of. And I literally got up out of my seat, said, I'm done. I can go home now. And that became my North Star. So when I was at the iLab and I met these guys, and I was not there to go find a company. I was just on my sabbatical, because the reality is even when things fail, if you have investors, they do take care of the entrepreneur. And so, I did better than I should have. So I was on my sabbatical, but when I got, you do the speed dating at the iLab, and I sat down with this guy, Zach. He was doing almost $100,000 a month out of his dorm room. I like you. And it was an education, which I had had some prior experience with. But it became to me the whole notion of looking for market signals that suggested there was a wave. And my sort of mental picture now, if I go to the Cambridge Innovation Center or the iLab, what I see is hundreds of people paddling on surfboards, trying to find waves. And the not often talked about sort of reality of this ecosystem, sort of really what we're talking about today, is half of these companies fail, a quarter of them go sideways, a few of them do better than that, and a very small number have sort of the big wins. It is an ecosystem that is defined by failure. And so I think the job of the entrepreneur is to manage risk. And good entrepreneurs are risk averse. They take calculated risks. They don't swing for the fences hoping something's going to happen. They do it because they see market signals, they're watching, they're learning, they're listening, and they go in a direction because the market is telling them, and because they have high comfort with ambiguity, key attribute of good entrepreneurs, they're able to sort of do zigs and zags as they follow what the market is telling them. So I think that's sort of, this notion of you gotta catch the wave, and to catch the wave, you have to be listening and learning, and that comes back to good entrepreneurs are great listeners.
And so we've talked a lot about failure. I think we're getting close to the end of our talk. So let's turn it around. Let's talk about success. And the reason we talked about failure today is so that we can take the lessons, and so other people can hear how college-age startups and people who've been through a few different companies have applied the lessons that they've learned from some of the mistakes they've made into successful ways. But you can also learn a lot as you're succeeding, and I think you're riding the wave of success right now, and I'm interested to hear the new things you're learning and applying on a daily basis. But I think first I'll start with you, Monique, and have you explain how when college students do start to get success, how do you keep them on track to make sure that they are still learning lessons and not getting too ahead of themselves?
Yeah, humbleness is definitely a big factor in that. I think that none of the student startups that we have seen has been so successful to be superseded by their arrogance. I think they all have been very gritty and very tenacious, and they've really had to be very smart in terms of how they deploy the resources or non-resources that they have. So I think that just never comes in. If we do have students that think their idea is the best thing since sliced bread, and they're going to be the next Mark Zuckerberg, we definitely have a talk with them to make sure that they calibrate some of that perception a little bit. And we have very strong mentors that actually are also empowered to give them that feedback. And I think that's very important. It's important to have a team of mentors in your corner that will really honestly reflect back to you and allow for that introspective to happen, because the humbleness factor is really important, and you will have to deal with that for the rest of your life. And so I think, to me, that's the biggest and most important aspect.
That's great. And right now, John, what are you, as you're we were talking backstage, and you mentioned, there's three types of startups. You're pushing the boulder up the hill, you're pushing the boulder sideways, and you're pushing the boulder downhill. And you said right now you have a sense that College Vine is pushing a boulder downhill. But as you're doing that, how are you avoiding kind of pitfalls, and what are you learning as you're succeeding in this point?
So think of there being sort of 3 points to a triangle to sort of how all these things work. So there's the idea, there's the team, and there's capital. So we've clearly got an idea that's taking hold. It was taking hold before I showed up, and it's continued to sort of, we've caught a wave. So now the next two pieces are the capital and the labor. So the team, so we're being very thoughtful about how we hire. We're using a lot of the tips and tricks and tools that I've learned from failures, from bad apples and so on. So I have very high bad apple DAR. So
can you give one, before you finish and explain, can you give one anecdote about a bad apple you dealt with and how that kind of threw a wrench in what you were doing?
Yeah, so at in the last company, we had an individual who had a very strong personality, had a number of failures, coming off of a bunch of failures, but had to win, strong personality, had to win every argument, had to shoot people down, so a culture of people ducking. So now you couldn't get healthy debate. Was prepared to go in a bunch of different directions, not focused, didn't have execution orientation, and so on. I think today, we're trying to sort of, I think we're being very good at, sort of how we hire. Been lucky, the team is awesome. Didn't know that early on, but we sort of had a few storming, but they're very self-aware. Self-awareness is key. So I want to talk about capital. We haven't talked about capital at all. So I'm going to bring up a few concepts, only a few minutes, but I think capital sort of matters to most people who are sort of in this game. So the first is investors care about 4 things. It's really only 4 things. And my sort of lesson is when I meet an investor, I start the meeting. You only care about 4 things, and I'm going to go through all 4. And if at the end of that 4, I'm going to ask you, did I check all the boxes? And if I did, then we probably are going to keep talking. It's like, okay. So the 4 things, investors want great teams, getting traction in big markets with believable models. And that's how they think. So everybody says they have a great team. So that, either if they're younger, that's a problem. Like for your guys, great is very subjective. As you get older, great is like how many stripes are you wearing and how many exits have you had and so on.
Yeah, a lot of people think that good means great, and they have a tough time realizing that something that is good isn't actually great.
Yeah, there's a lot of ambiguity. So just a quick couple of nuggets. Pointers that, in the world of financing, which is brutal, because that is rejection. Even if you're in my world, you get turned down the majority of the times. So, point number 1, avoid posers in the angel world. There are a ton of wealthy folks who like to play pretend VC. And they'll have breakfast with you at the Charles, and they'll want to hear about your plan, and they haven't the slightest intent of making an investment in you or probably anybody else. Maybe 1 every 2 years, but they're not real. So you want to ask, what kind of investing are you doing? How much capital are you deploying this year? What do you look for? Show me your portfolio, et cetera. Point 1. Point 2, avoid zombie venture funds.
Can you explain? I know what a zombie venture fund is, and this is a difficult thing to figure out whether you're dealing with one or not. But can you explain what a zombie venture fund is?
So a zombie fund is a fund that's out of fuel. They're out of gas. And because the returns either haven't been that good or have not yet been realized, they can't raise the next one. So you've got, Fred the partner who's getting a 2% management fee, who's taking meetings, but he's got no gas.
There's no way, he doesn't have any money to invest, so he's not investing, but he's still potentially pretending that he will.
He's pretending, and if he finds deals, he can show his limiteds, hey, I'm still in the flow, and so on. So avoid the zombie guys and ask, where are you in your fund? Are you in the first year, second year, third year? If they're more than 3 or 4 years out, are you raising the next fund? Because funds are typically entirely committed within the first 3 years. The last piece is, if you can, try to avoid rookie VCs. Rookie VCs have the unfortunate characteristic of they're new and they're trying to prove themselves to their partners, so they can get very anxious when you hit speed bumps. All companies hit speed bumps. We hit them. We had one this summer. We got through it. But they're nervous Nellies. And so they're really hard to have as board partners. So the rookies, you really want to sort of have somebody who's been in the game for a while and is not having to prove themselves to their partners. And so that reduces sort of some of the insecurity. With that, I'll stop. We've only got a minute.
No, that's great. And I think that it's great to finish in that way as we near the end here, to kind of have these last pieces of advice that are important to share. But it's not coming out of nowhere. It's coming out of your own experience and having dealt with this before.
One last one quickly. Capital comes in 2 flavors. There's hard capital, which everyone thinks of as cash, but there's also in-kind capital. And that comes in the forms of sweat equity, free rent, lawyer giving you pro bono. Don't overlook the sort of intangible soft capital. Job of the entrepreneur is to draw capital in the enterprise, but capital can come in soft forms as well as hard.
And do you have any other last lessons or experiential things to share, having dealt with these college startups that you've learned over the years, and as you said, even running Accelerate because you see it as a startup yourself?
I think making sure that you sustain a beginner's mindset is really important. John Kabat-Zinn was one of the first ones to define the beginner's mindset, to sustain an open mind and get into the learning mode. I think that's really critical on actually listening to your customers, being able to listening to the market and understanding venture capital and how you would actually approach it. I think that's really critical to the experience, regardless in which stage you actually are.
I think, if anything, if you can take anything away from this discussion, we're just at the tip of the iceberg to some degree in how you can learn from making mistakes, you can learn from failure, and you can apply things that you may have not done well, turn around and make them successful. And VC is obviously one that we could talk about for another hour, but we're nearing the end here today. Thank you all for coming. I think we're, in this discussion about failure, we're all pretty happy that something did succeed here, which is this biodome, as it felt like a little while with the rain outside that maybe things were going to go a little haywire there. But thank you guys for this panel. Thank you all for coming. I hope you have a great rest of your HUBweek experience. Thank you.